What happens when a government runs out of money to pay for a war, but refuses to admit defeat and quietly decides someone else should pay instead? Stay with me on this one, because it's not a hypothetical. It's happening right now. Hit like, subscribe, and drop a comment with just one word so this reaches more people, because independent economic analysis like this rarely survives the algorithm without your help. For 4 years, one government has been fighting an enormously expensive war. Wars cost money, obviously, but this one has cost far more than anyone in the Kremlin ever budgeted for, and the treasury that was supposed to cover it has been running dry for a long time now. Normally, when a state runs low on cash, it has a handful of options. Raise taxes, borrow more, print money. Russia has quietly done all three, but there's a fourth option too, one that's harder to spot from the outside because it never shows up cleanly on any government balance sheet. Instead of paying for the war directly out of the state's own pocket, Moscow appears to have shifted a significant share of that cost onto its own commercial banks, and through them, onto the ordinary people who trusted those banks with their savings. It's the kind of maneuver that looks almost invisible from a distance, buried in loan restructurings and subsidized credit lines rather than splashed across a headline. And that invisibility is precisely what makes it so effective and so dangerous. This isn't speculation dreamed up on social media. European intelligence assessments reportedly reviewed by international news agencies have specifically flagged the risk of a Russian banking crisis taking shape in 2026, describing a system that looks stable on the surface while concealing genuine fragility underneath. The language used in that kind of assessment tends to be careful and measured, the sort of dry, cautious wording intelligence analysts use precisely because they're not in the business of making dramatic predictions. And yet, even through that careful, understated language, the underlying picture being described is genuinely alarming. Hundreds of thousands of ordinary Russian citizens have formally declared personal bankruptcy over the past year alone. A meaningful share of corporate loans across the country are now considered doubtful, unlikely to ever be repaid in full. At some of the country's largest banks, a significant portion of everyday consumer loans, car loans, credit cards, personal loans, are now sitting in default or close to it. The headlines out of this war have mostly focused on the battlefield, on missile strikes and territorial gains and losses. But there's a second front to this story that gets far less attention, and it's arguably more consequential in the long run. It's the financial system quietly absorbing the cost of a war that shows no sign of ending, one loan, one deposit, one frozen account at a time. Today, we're going to walk through exactly how that mechanism works, why it may already be reaching a genuine breaking point, and what happens to millions of ordinary people caught in the middle of a financial system built on debt that was never designed to be repaid. Let's start with the mechanism itself, because understanding how this actually works is the key to understanding everything else. When a government drains its treasury fighting a prolonged war, it typically faces three unattractive choices, and all three come with real political and economic costs. Raising taxes is unpopular and slows the wider economy. Borrowing on international markets becomes difficult or impossible under sanctions. Printing money fuels inflation, which erodes public trust just as quickly as an unpopular tax hike would. Russia has leaned on all three tools to some degree over the past few years, but there appears to have been a fourth, quieter lever pulled alongside them, one that doesn't show up as clearly in official government statistics, rather than directly financing defense production and infrastructure projects out of the state budget. The government appears to have pushed much of that responsibility onto commercial banks instead, through a wave of subsidized lending directed at defense manufacturers, regional development projects, and heavily subsidized mortgage programs. Here's why that particular move is so clever from a pure accounting perspective, and so damaging from almost every other angle. A bank's money isn't really the bank's own money. It's made up overwhelmingly of deposits, the savings of ordinary account holders who trusted that institution to keep their money safe and accessible. When the state effectively directs banks to extend enormous volumes of credit toward war-related projects, the cost of that spending gets spread quietly across millions of individual bank accounts, without a single voter ever being consulted about it. And because it flows through private balance sheets rather than the government's own books, it doesn't immediately register as war spending in any of the headline economic figures. Factories keep running. Construction sites stay busy. On paper, the picture looks like a functioning, even thriving economy. The problem is what's actually backing all of that lending. It isn't real, sustainable business profit. It's the war itself, and war, by its nature, doesn't generate profit. It generates enormous consumption and enormous debt that eventually has to be repaid by someone. Financial analysts have a specific term for what happens when a loss like this doesn't get written off honestly, but instead gets quietly deferred into the future through constant restructuring and rolled over credit. It's a way of financing today's spending using tomorrow's balance sheet, and the price for that kind of deferral always arrives eventually, usually at the worst possible moment. So what does that fragility actually look like underneath the surface? According to figures attributed to Russia's own central bank, a very large share of the debt held by the country's biggest companies could run into serious repayment trouble, with coal, construction, retail, and heavy machinery sectors flagged as particularly exposed, the exact industries where millions of ordinary workers, miners, builders, factory hands earn their living. Layered on top of that is the enormous volume of credit extended specifically to defense manufacturers to rapidly expand production capacity since the war began, estimates for which reportedly run well into the hundreds of billions of dollars. Financial commentators have described that pool of defense-related lending as something close to a ticking time bomb sitting quietly inside the banking system, because nobody has a clear answer to an obvious question. On the day the war actually ends, or even just slows down enough that defense orders start drying up, what exactly would those factories use to repay all of that borrowed money? That's the bitter irony sitting at the center of this entire structure. The system can only really hold together as long as the war continues. Peace itself, paradoxically, becomes something close to a financial shock, because the repayment capacity of an economy propped up almost entirely by wartime orders evaporates the moment those orders stop coming in. In the meantime, banks appear to be doing what struggling banks around the world often do when faced with a wave of bad loans they'd rather not acknowledge. They keep restructuring, extending maturities, rolling debt forward rather than writing it off. It's a practice sometimes referred to as evergreening, essentially feeding a dying loan with fresh credit to keep it technically alive on paper. The books look clean, the immediate numbers look manageable, but every time a loss gets deferred rather than resolved, the eventual reckoning grows a little larger, and in the meantime, capital that could be funding genuine, productive investment elsewhere in the economy is instead being spent propping up loans that were probably never going to be repaid anyway. A very similar pattern appears to be playing out in the housing market too, where heavily subsidized, artificially cheap mortgage programs push demand and prices upward, encouraging ordinary households to take on debt loads many of them can't comfortably sustain. On a bank's books, that translates into a pile of assets that look secure on paper but rest on much shakier ground underneath than the official figures suggest, according to reporting from independent Russian language outlets. The number of banks operating at a loss climbed sharply within just the first couple of months of this year, reaching levels not seen since the early period of the full-scale invasion. Even research centers with ties to the Kremlin itself have reportedly acknowledged in cautious and hedged language that the country may already be facing a genuine banking crisis. There's an uncomfortable calculation buried underneath all of this, too. If a handful of smaller regional banks fail, the state will likely allow it to happen quietly, absorbing the political cost rather than the financial one. But the largest banks, the true arteries of the entire financial system, are a different matter entirely, and the state would almost certainly be forced to step in and rescue them if it came to that. The trouble is that any rescue effort has to come out of a budget that's already stretched thin trying to fund the war itself, which leaves the government facing an uncomfortable choice, hiding just beneath the surface of every policy decision it makes from here forward, whether to keep propping up the banks or keep funding the war, because doing both indefinitely may simply not be possible. Now let's talk about the human side of this story, because behind every one of those cold statistics sits an actual household. Hundreds of thousands of ordinary citizens formally declared personal bankruptcy over the past year alone, a meaningful jump compared to the year before. That's not an abstract line in a financial report. It represents hundreds of thousands of real families formally acknowledging they simply cannot pay what they owe. Clips have circulated online of ordinary people describing their frustration directly, struggling to run small businesses or even afford basic fuel despite living, as more than one person has put it, in what's supposed to be a modern, developed country. How exactly did so many households end up in this position? Aggressive, state-encouraged lending programs pushed many people into taking out multiple loans simultaneously. Wages, even though they climbed on paper thanks to the wartime economy's demand for labor, never fully kept pace with inflation, and interest rates have remained painfully high for a long stretch of time. According to various figures circulating in economic reporting on the country, millions of Russians are now juggling more than one active loan at once, with a growing number reportedly using one loan simply to make payments on another. Individually, each of those situations is a private, personal hardship. Collectively, it's a systemic risk quietly building beneath the surface of the entire financial system. Because when one link in that chain snaps, a layoff, a medical emergency, a sudden price spike, the entire chain can come apart quickly, and on a bank's books, that transforms overnight into another bad loan added to an already growing pile. One particularly striking figure making the rounds suggests a large majority of Russian households have meaningfully cut their grocery spending over the past year, with similar contractions showing up across clothing purchases and eating out. So on one side of the ledger, you have enormous credit lines flowing toward defense manufacturers and state megaprojects. On the other side, you have an ordinary family quietly shortening their weekly shopping list. Both of those are lines sitting on the exact same national balance sheet, and both appear to be deteriorating at the same time. It's a strange, uncomfortable kind of inequality, not the usual gap between rich and poor you'd expect from a struggling economy, but a gap between a war machine that keeps getting fed and a population that's quietly being asked to eat less so that it can. When forced to choose between funding basic public services and funding the war effort, the government's actual spending decisions over the past few years have made that choice fairly clear already. We're just getting to the most consequential part of this story, so if you've made it this far, take 30 seconds and share this with someone who still thinks Russia's economy is holding up fine, because what comes next is the part where ordinary people start losing access to their own money. So how does all of this actually land on an ordinary person going about their day? Quite directly, it turns out. Since the beginning of this year, a very large number of Russian citizens have reportedly had their bank accounts and cards frozen suddenly, often with little to no clear explanation. People trying to buy groceries, pay bills online, or send money to a relative have described opening their banking app only to find a blunt notification. Transaction suspended. Account under review. Citizens who've pushed against their bank demanding an explanation have reportedly been met with a specific piece of legislation aimed at preventing money laundering and terrorism financing, a law that in ordinary times exists for legitimate reasons, but which now appears to be applied broadly enough to catch pensioners collecting their own pension, homemakers withdrawing modest sums, or ordinary people sending a few $100s to a family member. Some individuals have publicly described being questioned extensively at bank counters simply for trying to withdraw their own savings, asked pointed questions about what the money is for, where they're headed, whether their taxes are fully paid, treated, in their own words, more like a suspected criminal than a customer accessing funds that belong to them. Reports describe people being asked to submit lengthy documentation and questionnaires that even bank staff themselves reportedly struggle to fully explain. The practical effect of all of this, intentionally or not, is delay. While a bank stalls a customer for days or weeks working through a review process, the customer's money simply stays parked inside the bank, rather than being withdrawn. And under existing account freezing rules, if a block isn't formally resolved within a set period of time, the funds involved can reportedly be seized outright. Why would a system behave this way? The uncomfortable, straightforward answer many analysts have pointed to is simple. The physical cash may genuinely not be readily available. Much of the money ordinary depositors placed into these banks appears to have already been funneled out through subsidized lending to defense manufacturers and state-backed projects. Exactly the loans we've already discussed that may never be fully repaid. As those weapons and that spending get consumed by the war effort, the underlying value backing ordinary people's savings effectively gets consumed along with it. Central bank officials have publicly acknowledged, in fairly understated terms, that anti-fraud measures may have gone somewhat further than intended in restricting ordinary account access. Meanwhile, those with the earliest and clearest insight into the health of the banking system, wealthy individuals and bank executives themselves, appear to have been among the first to quietly withdraw significant sums as a precaution, contributing to a broader wave of deposit withdrawals reported across the country in just the first month of this year alone. To manage the resulting anxiety and prevent a full-blown panic from spreading further, authorities have reportedly taken increasingly drastic steps, including periodic mobile internet restrictions in various cities, moments where ATMs simply stop dispensing cash, and situations where accessing a banking app at all requires workarounds that wouldn't have been necessary just a couple of years ago. Some financial commentators have started describing the entire structure in blunt terms, closer to a pyramid scheme than a conventional banking system, one that requires a constant flow of new money simply to keep servicing the obligations already piled up from before. When a country's own finance ministry starts publicly floating the idea that citizens' savings could be redirected toward broader economic development goals, that's not a subtle signal. It's about as close to an open warning as officials in that position are ever likely to give. So what could actually be the spark that turns this simmering fragility into a full-blown crisis? According to the intelligence assessment already mentioned, the most likely trigger is an external shock, and there are a few candidates already lining up. Further rounds of international sanctions, specifically targeting additional Russian banks and crypto payment networks, have reportedly been under discussion, potentially doubling the number of blacklisted institutions and cutting off more than half of the country's internationally connected banks from the global financial system entirely. Here's the subtle but important point buried in that kind of warning. Russian banks have proven remarkably resilient at absorbing years of gradually escalating sanctions pressure already. The system has essentially built up scar tissue and adapted around the restrictions already in place. But resilience against gradual, familiar pressure is different from resilience against a genuinely sharp, unexpected shock. And the assessment's core warning is that the system's remaining capacity to absorb that kind of sudden blow may be far thinner than it appears from the outside. One particularly telling detail buried in that kind of analysis is worth sitting with for a moment. By this point in the war, so many individual sanctions have piled up over so many years that a significant number of ordinary customers at already sanctioned banks reportedly aren't even fully aware their own bank is under restriction. Familiarity with an ongoing, gradual threat has a way of making that threat feel invisible, right up until the moment it isn't anymore. A financial system that's already stretched thin can be toppled by a disruption it might easily have absorbed a few years earlier under healthier conditions. The real economy underneath all of this isn't holding up particularly well either, which only compounds the pressure on the banking system further. Sustained drone campaigns targeting refining infrastructure have reportedly knocked out significant fuel processing capacity for extended periods, with some facilities not expected to return to normal output for a considerable stretch of time. Energy exports have historically financed a substantial share of the national budget, sometimes close to half in stronger years. And as that revenue contracts under sustained pressure, the government's ability to prop up its own banking sector shrinks. Like steel has reportedly fallen to multi-decade lows under the combined weight of sanctions and softening demand. And as factories outside the defense sector run short of orders, layoffs inevitably follow, each one adding another household to the growing pile of unpaid loans sitting on some bank's books somewhere. Official economic growth forecasts have already been revised sharply downward, with government projections for the coming years cut substantially compared to earlier, more optimistic estimates. Facing this combination of pressures, the reflexive policy tool available to any government in this position is simply printing more money, but that particular lever comes with an obvious catch. Every additional unit of currency printed adds fuel to inflation. Inflation forces interest rates upward to compensate, and higher interest rates make every existing loan across the entire economy, corporate and household alike, meaningfully harder to service. In effect, the available response to the fire risks pouring more fuel directly onto it. Now, to be genuinely fair and balanced about all of this, because that matters here, this doesn't mean total collapse is imminent or guaranteed. That kind of intelligence assessment isn't a prophecy. It's a probability estimate, a statement that conditions exist for a serious crisis if a large enough shock arrives, not a declaration that collapse is inevitable on any specific timeline. Russian banks have already absorbed roughly 4 years of escalating sanctions pressure with more resilience than many outside observers initially expected. Central bank officials have publicly downplayed the likelihood of a full-scale crisis, and policymakers still have some tools left to work with, including recent interest rate cuts aimed at easing the broader borrowing burden across the economy, even though lower rates only slow the growth of existing debt rather than actually resolving it. There's also real value in some humility about timing here specifically, because predictions of imminent Russian economic collapse have circulated repeatedly throughout this war already, and the system has consistently proven more durable in the short term than many forecasts anticipated. Still, the structural dilemma facing policymakers remains genuinely difficult to escape. Keep interest rates low and inflation risks spiraling further out of control. Keep them high, and the debt burden crushing companies and households alike becomes increasingly unsustainable. There isn't an obvious lever left to pull that doesn't create serious problems somewhere else in the system. And unlike previous periods of Russian financial stress, where rising global oil prices, open international markets, and incoming foreign investment eventually provided a path back toward recovery, several of those same escape routes look considerably narrower this time around. With energy infrastructure under sustained attack, many international markets closed off entirely, and capital increasingly reluctant to flow back in. What all of this ultimately describes is a banking system that has, by many credible accounts, become something closer to a financing mechanism for an ongoing war than a conventional financial institution serving its own citizens' economic interests. It's a system carrying enormous volumes of debt that generates little genuine profit, staying upright mainly by continuously deferring its losses into the future rather than resolving them, gradually losing the trust of the very depositors it depends on, and increasingly exposed to whatever external shock eventually proves large enough to overwhelm its remaining capacity to absorb bad news. If this kind of system does eventually reach a genuine breaking point, it likely won't announce itself as one single dramatic headline. It's far more likely to unfold gradually and quietly instead. Smaller regional banks get merged away or shut down without much fanfare. Access to certain deposits gets temporarily restricted here and there under the guise of routine compliance procedures. The state spends down whatever reserves it has left, trying to rescue whichever handful of banks are considered simply too important to fail. And the very first sign an ordinary person actually notices probably won't be a news alert about a bank collapsing. It'll be an ATM that quietly stops working one morning. Exactly the kind of small, mundane failure that doesn't make headlines on its own, but adds up to something much larger over time. And the people absorbing the real cost of all this were never the ones who made any of the decisions that led here in the first place. It's the pensioner watching a lifetime of careful savings quietly lose their value. It's the small shop owner who can no longer make payroll. It's the ordinary family that's already been forced to shorten its grocery list month after month without much choice in the matter. The single most important signal to actually watch here isn't whether any one particular bank formally fails on any given day. It's whether ordinary people keep quietly pulling their money out of the system altogether. Because a genuine banking crisis rarely begins on the official day. It finally gets declared. It begins earlier and more quietly than that. On the day, enough ordinary people simply stop believing the system will still be there for them tomorrow. And that's really the story sitting underneath every statistic in this entire video. Wars have always been paid for eventually, one way or another, whether the bill arrives immediately or gets quietly pushed years down the road. What's happening inside Russia's banking system right now looks a lot like a government trying to outrun that bill for as long as possible, refinancing it, restructuring it, deferring it, hoping something changes before the debt finally comes due in full. But debt deferred is never debt forgiven. It simply waits, growing quietly larger in the background, for the moment someone finally has to pay it, based on everything happening. Across that country's banks right now, a great many ordinary people already seem to sense that moment is getting closer, and they're voting with their savings, one quiet withdrawal at a time.